Are you aiming for 1 million ARR to raise your Series A? Stop right there. Because in 2026, that's not a Series A metric anymore. That's what we're calling a respectable seed round. The goalposts haven't just moved, they've been picked up and driven to another borough entirely. Planted in the soil is considerably more expensive. I'm going to show you exactly where those goalposts are now. Because if you're still playing by 2022's rulebook, you're not just behind, you're in a completely different league. Welcome to the new reality of Series A fundraising. Buckle up, because the numbers are about to get uncomfortable. Let's start with a bit of nostalgia, shall we? Back in 2021, during what we now affectionately call the silly season, you could pitch a Series A with 750 to 1 mil ARR, some questionable unit economics, and a deck that was essentially vibes and ambition. Investors would practically throw money at you like they were feeding the pigeons in Trafalgar Square. But 2021 was also the year people were buying JPEGs of monkeys for 6 figures. So perhaps we shouldn't use it as our North Star. Here's what actually happened. According to PitchBook's Q4 2024 data, Series A deal volume in Europe dropped by 38% compared to 2021. Not a bit down, 38%. That's not a correction, that's a proper recession in venture capital terms. Meanwhile, Carter's State of Private Markets report from late 2024 shows that the median Series A revenue multiple, that's valuation divided by ARR, collapsed from 20x in 21 to just 6x by the end of 24. So what does this mean in plain English? It means investors got considerably more careful about where they park their capital. The era of funding potential is over, and we're back to funding proof. And in 2026, proof requires bigger numbers, better unit economics, and frankly, a level of operational excellence that would have seemed downright boring in 2021. The old benchmark of 1 million ARR for Series A, that'll get you meetings. It won't get you any term sheets. The new metric stack, revenue. So let's talk about the new safe harbor for Series A, revenue. According to ChartMogul's 2024 SaaS Benchmarks report, the median ARR for a Series A company has shifted to approximately 2 million to 3 million pounds. Some ambitious funds are even pushing that floor to 3.5 million for competitive rounds. Now, before you throw your laptop out the window, wait, laptops are pretty expensive, don't do that. Let me explain why this makes sense, even if it's pretty annoying. First, investor expectations have been recalibrated by inflation and higher interest rates. The free money era is over. Funds need to deploy larger checks to make their returns work, which means they need companies that can absorb that capital and deliver efficient growth. 5 million Series A into a company doing 1 million ARR, that's a scary burn rate waiting to happen. But 5 million into a company doing 2.5 mil ARR with a proven growth engine, now you're talking about scaling something that actually works. Second, and this is the bit that nobody really talks about at networking events, raising at higher revenue levels means less dilution for the founders. If you're doing 2.5 mil ARR with sound metrics, you're in a position to command better valuations and keep more of your company. PitchBook data from Q3 in 2024 shows that companies raising Series A at 2 million plus ARR maintained on average 15% more equity than those raising at sub 1 million levels. And that's not marginal. That's the difference between properly wealthy when you exit versus just a bit comfortable. Think of it this way. Would you rather raise at 1 million ARR and give away 25% of your company, or go out for another year and hit 2 million ARR and give away just 18? The latter means you keep an extra 7% of what might become a 100 million venture. Do the maths. That's 7 mil. That's not paying for a nice holiday. That's buying a house in Notting Hill without a mortgage money. The new metric stack, efficiency. Right, let's talk about everyone's favorite topic, burning through capital like it's going out of fashion. Except in 2026, investors have a new way of measuring whether you're burning smart or just burning. It's called the burn multiple. It's brutally simple. Burn multiple equals net burn plus his net new ARR. In other words, how many pounds are you setting on fire to generate each pound of new annual revenue? According to 2024 analysis by venture capital data from SaaS Capital, the median burn multiple for successful SaaS companies has tightened to approximately 1.5x. That means for every pound of new ARR you add, you should be burning no more than £1.50. Let me give you an example that'll make this kind of real. Company A adds 500k in new ARR, but burns to 1.5 million doing it. Burn multiple 3x. That's not good. That's have a seat. We need to talk about your CAC payback period territory. Company B, they had 500k in new ARR and they only burned 600k. Burn multiple 1.2x. That's efficient. That's what VCs in 2026 want to see. Now, here's the kicker. Back in 2021, investors tolerated burn multiples of 3x, maybe even 4x, even higher if you're in a hot growth category. Growth at all costs, remember? But Carter's data from late 2024 shows that companies with burn multiples above 2x were 60% more likely to successfully raise Series A compared to those below 1.5x. That's 60%. Why? Because we've entered what I call prove it twice. Investors don't just want to see that you can grow. They want to see that you can grow without hemorrhaging capital. This is particularly true in the UK and Europe, where investors have always been a bit more, let's say, prudent than their Silicon Valley cousins. The days of funding money-losing rocket ships are over, and now they want profitable fighter jets. The new metric stack, retention. Let's move on to retention, because this is where most founders quietly panic and then try to change the subject. Net dollar retention, or NDR, is a percentage of revenue you keep from existing customers over time, including expansions, but accounting for churn and downgrades. And in 2026, if your NDR isn't above 110%, you're going to have a very difficult conversation with investors. ChartMogul's 2024 data indicates that top quartile B2B SaaS companies are now posting NDR figures between 115 and 125%. The median has shifted to approximately 110%. Why does this matter so much? Because NDR is the ultimate sign of product market fit. It tells investors not only do customers stick around, they actually spend more over time. Here's the uncomfortable truth. If you're losing 15% of your revenue to churn every year, and you need to replace that revenue plus grow on top. You're running up a down escalator at King's Cross during rush hour, exhausting and efficient. But if your NDR is 120%, that means even if you didn't sign a single new customer, your revenue would still grow by 20% year over year. That's growth on autopilot, and that's kind of the dream. According to analysis from venture firm Battery Ventures, companies with NDR above 120% receive Series A valuations that are on average 40% higher than those with NDR below 100%. 40%. That's the difference between a 20 mil valuation and a 28 mil valuation. Same revenue, different retention story. 8 million in additional company value. And before you ask, no, can't fake NDR. Investors will ask for cohort analysis going back 18 to 24 months. They'll see the truth. So if your retention is shocking, fix it before you go out to fundraise. Don't try to polish that particular turd. The shadow metric, revenue per employee. Now we get to what I call the shadow metric. The one that doesn't always appear in pitch decks, but absolutely comes up at partner meetings. Revenue per employee. And in the age of AI, automation, and doing more with less, investors expect that this number will be substantially higher than it was even 2 years ago. Traditionally, a healthy B2B SaaS company might generate 100k to 150k in revenue per employee. That was the standard. But according to 2024 data from venture firm OpenView partners, investors are now looking for companies generating upwards of 200k per employee, with best-in-class companies hitting 250 to 300k. Why the jump? 2 words: AI productivity. With tools like ChatGPT, Notion AI, Intercom's AI agent, and automated customer success platforms, the expectation is that modern startups should require fewer humans to generate the same or more revenue than previously. This isn't about being callous towards employees. It's about capital efficiency. And if you're generating 3 mil in ARR with a team of 40 people, that's only 75k an employee. You're going to get some questions about operational efficiency. But if you're generating 3 mil with a team of 15, that's 200k per employee. Now you're interesting. Now you're showing that you've built leverage into your business model. Let me give you a specific example from the field in 2023. A typical Series A SaaS company with 2 million ARR might have employed 20 to 30 people. By 2025, according to ChartMogul's analysis, companies hitting the same revenue milestone are doing it with 15 to 20 people. That's a 33% reduction in headcount for the same output, and that reduction flows straight to the bottom line. Or rather, it means you burn less capital to achieve the same growth. So here's my advice. Before you walk into that Series A meeting, calculate your revenue per employee. If it's below 150k, be prepared with a very good explanation for why your business requires more humans than your competitors. If it's above 200k, lead with it. Put it in your deck. Make it a talking point. Because in 2026, capital efficiency isn't just important. It's a competitive advantage. So let's bring it all together now, shall we? The new Series A in 2026 looks like this. Revenue, 2 mil to 3 mil pounds, ARR minimum. 1 million gets you seed, not Series A. Burn multiple, under 1.5x. Prove you can grow without setting money on fire. Net dollar retention, 110% minimum. 120% plus if you want to be competitive. Revenue per employee, 200k plus in the age of AI and automation. These aren't suggestions, these are the new table stakes. Is it harder than it was in 2021? Absolutely. Is it impossible? Not even close. It just requires more focus, better execution, and a willingness to build a real business instead of a fundraising machine. Founders who understand these new benchmarks aren't complaining about how unfair it is. They're busy hitting these numbers. So the question is, are you going to spend 2026 wishing that the old rules still applied, or are you going to adapt, execute, and raise capital your company actually deserves? The choice, as they say in every mediocre business book, is yours. If you found this useful, drop a like, subscribe for more brutally honest startup content, and leave a comment telling me which metric you think is the hardest to hit. I promise I'll read them all, even the angry ones. See you in the next one.